We were kind of hoping that we get a good strong bullish move today, tomorrow, to really get a good breadth thrust through that moving average on the 30-day moving average, get that intermediate line into the upper half of that market forecast and really get going to the upside. And instead, we kind of had the opposite, right? We actually had a pretty significant down day. They got worse throughout the day and ended up down at the lowest. A lot of it has to do with the Fed and their rate hike odds, rate cut odds, I guess. Dropping, in fact, dropping below 50% now for September. So really, we're in fact, there's only pricing in really one rate cut now for the entire year, and the odds for no rate cuts for the entire year, it's gone up to 25%. So we've seen this pattern play out before, where rate cut odds are priced out. The market drops during a period of little pullback here, nothing too major. And then when the rate cut odds get priced back in without actually cutting, we just get the odds priced in, the market rallies up really strongly up to new highs. So I still think we're in that mode. Today's pattern, I'm going to kind of show you that as much I don't really think that today's move will be that. It's like foretelling a bigger move to the downside. I still think we're on track for a new intermediate run to start to the upside. There are some red flags, especially in terms of some of the asset correlations and what sectors are doing right now. There's a very strong rotation in the safety. I'll show you that in today's pattern. So there's some red flags we need to be aware of, which in my opinion doesn't mean we won't get a bullish intermediate run. It just means it'll be one of the smaller ones that probably won't go up as much. But we'll take a look at all of that, break down the technicals, what I'm showing, what I'm seeing, and then our trade idea as a stock that's broken down big time itself and is broken below a really important support level. And in fact, it actually kept moving after we put the trade on the Market Outlook Live video before the market close. So we'll take a look at how to trade that. So let's go ahead and get started. Today is Tuesday, April the 30th, 2024. This is the Market Outlook from MarketScholars.com. My name is David Settle. Before we get going too far, I invite you to subscribe to our YouTube channel with this icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. If you're watching us here on our blog, check out some of these other things over here on the right, including our Market Outlook Live video. This is where I take a look at all the trades we've done, follow up on them, see whether we should stay in them, get out of them. I put on today's already before the market closed during that live class. Come down to the bottom, click this heart. It opens up this tab. Hit that like button there. Same thing here. Click the thumbs up icon. It opens up this tab. Hit that like button. Again, the more you do that, it helps get our content out to all of our followers on those platforms. So thank you to those who do this day in and day out. Those who don't, you can do it right now while you're watching with one or two really easy clicks. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. You can see the decline. We filled in this gap from a couple of days ago. And we're back to dark pink shading. Dark pink shading, which means the intermediate line is below 50 and turned lower. So we're back to dark pink shading and a red line. So instead of getting to dark green shading, which we would have probably had, if we would have had this kind of day to the upside today, we would have had dark green shading. Instead, we turned back down with dark pink. We're back to 2% below the moving average. The momentum line drops back down to extreme lows, would suggest there's a good chance the near-term line gets down to significant lows as well. So a lot of that's coming up on the day. The intermediate line still below market sentiment. Near-term line still above the intermediate line. So we'll see. Obviously, if it's going to get into the reversal zone, it's going to get below the intermediate line. But yeah, you're still in bearish territory now, back in bearish territory, just barely. You were just barely out of it yesterday. You're barely back into it today, but you're in bearish territory nonetheless on the S&P 500. Of course, your NASDAQ 100 looks very similar, almost looks exactly the same. The near-term line is into the lower half of the chart. The intermediate line did not drop into bearish territory. It stayed just a little bit above, but you are back to dark pink shading because it did go down a little bit there, so they're both falling. In fact, all four lines are falling. The momentum line fell to the lowest point possible on the NASDAQ, which means pretty much that we closed at the low. 17, yeah, we closed right at the low point on the NASDAQ 100, so that's pretty much the only way you can get to zero, exactly zero there on the momentum line. We're down 2.5% again. We were down quite a bit. with some red dots down here, which means we're in the 10th percentile. So we had made a move back up, didn't quite get above zero, and now have turned back lower. Your Dow Jones started the day already with a more bearish posture because the intermediate line was still in bearish territory, and market sentiment line's actually out of bullish territory. And now we're back again, extreme low on the momentum line, near-term line below the midpoint of the chart, and you are almost back into the reversal zone on the intermediate line. So pretty quick, again down 2.25% there, dark pink shading in a red line, back below the 23% retracement on the Dow Jones. Remember, the S&P is actually, when you look at the SPX here and bring up its Fibonacci lines, you can see we're still above the 23% retracement line. So the Dow Jones now is below it. So you're back into retrace. Remember, we were below it for a longer period of time than the S&P, and we were just kind of barely above it. And we're rolling back down. And then finally your Russell 2000. When you look at your Russell 2000, again, you have a bearish pattern here. The dark pink shading in a red line still, intermediate line still below market sentiment. They're both falling. Market sentiment's out of bullish territory. Intermediate line's in bearish territory. So when I say that, bearish territory is a pink area. Bullish territory is a green area. So anything above 60, anything below 40 is bearish. Extreme low on the momentum line. Near-term line drop below the midpoint of the chart. But still above the intermediate line. And we're about almost 3% below the moving average. So very similar patterns across the board. The Russell 2000 falling 2% today. So when you look at that, I mean, it's not the first 2% down day, but they're just not very common. Let's see, let's go. Obviously, you haven't had one on SPY for over a year. The Russell 2000 had one back here on April the 10th, my birthday no less, and we were down 2.6%. So you're down 2% again. So we've had plenty of 2% moves on the Russell 2000. After gapping down almost a full percentage point, more than one standard deviation. So interesting day. We'll take a look at that here in just a second. But bearish patterns nonetheless all across the board. If you take a look at the weekly chart here, you can see again we're back to a transition candle still though. But in this case, the transition candle, instead of being strongly bullish right now, is actually pretty bearish. So we'll see how the week ends, how we finish up the week. You did get a green arrow last week, which means we closed back above the 10-week exponential moving average. We are back to a red arrow this week, so that's kind of something we need to kind of keep an eye on, because you want to, if you get a green arrow and stay above it, that's actually a pretty good bullish sign. So we'll kind of watch that and see if we continue this bearish trend. Of course, again, we've got a higher low point already. We have a higher Hakinashi close. So, again, barring a big breakdown here below like some of these lows, as of right now, that's actually not a bad sign for next week being more bullish. So we'll just kind of keep our eyes on that. Your 3 green arrow chart, you still don't have 3 red arrows in any of these indexes. So as bearish as it was today, you have 2 red arrows in the S&P, but your MACD is still bullish. We talked about that in yesterday's market forecast, that it's going to be a day or two before the MACD can get red in the worst case scenario. You got 2 red arrows pretty much on everything except for the MACD. Is the only one that's not red on any of the major indexes. All of the major indexes are showing are what is called phantom red arrows, which are a lot more bearish than a regular red arrow, right? So when you turn down, see, we haven't had a phantom red arrow for a long time either. Every time we've rallied, we've gotten up into the reversal zone. But this is the first time that we've come out. So come out of the lower area here. Let me zoom out so we can get some context here. This is the first time we've come out of the lower area and had a phantom. See, all these other times that we've gotten below, a little bit of a phantom arrow there, but we turned right back up and got turned back to green, and we got back up to the upside. Some of these moves here, you can see a phantom red arrow, how bad that was, how bad it was here too. So getting phantom red arrows are relatively bearish when you're coming off of out of the lower reversal zone, right? Here you got a few phantom arrows, but you were coming off with some pretty good bullish lows. Here you got a phantom red arrow, so I missed this one, and I missed this one too for that matter. You're barely in the reversal zone there. But even those were pretty bearish and caused new legs lower to the downside. So, I mean, unless we can reverse this move tomorrow, that's a pretty ominous sign, getting a phantom red arrow here, and again, on all the major indexes. If I break down the 3 green arrow charts on these lines, you can see we are back below after failing at the 50-day moving average, closing above the 17-day for 2 days. We're back below the 8-day just like that. The MACD is still above its moving average. Stochastics is out of bearish territory. It's still above its moving average, but not quite into bullish territory there. So it's not like we're strongly bullish here or bearish either. Again, the Dow broke that 23% retracement. Same thing on its MACD and stochastics is very similar. The difference here is you are well below that 50, working your way towards the 200, and also working to get back into the value area. See, the S&P is nowhere close to the value area. You still got a long ways to go there. So a little bit more of a bearish drop on your diamonds. Your Russell 2000 also a little bit more closer to the 200-day. You're also below the point of control. Well inside the value area on the excuse me, not the diamonds, on IWM, on the small cap index, but your MACD and stochastics again looks almost exactly the same. If I take a look at some of the other oscillators, your DMI on the S&P, your positive indicator is back below 20. Your negative indicator is actually back above 30. So you're back to a spot where the ADX can continue to rise to the upside. Your RSI and your CCI avoided getting into bullish territory. You're back below 0 on the CCI. You're back below 50 on the RSI. So we can't, remember, it has to cross above 50. And then to change the color, we have to get above 60, right? So we got above 50, but we didn't ever get above 60, and we can, now we've turned back lower. So still bearish there on the S&P 500. Your Dow Jones Industrial Average is worse because you're actually below 40 again, and then they're below 0. You can see on the weekly CCI, we are below minus 100 on the weekly CCI for the Dow, so it kind of goes to show just how bearish the Dow is. If you look at the Russell 2000, we came really close a couple of weeks ago to getting below minus 100. We got to minus 86. We're still at pretty negative levels, so not bearish levels yet on the Russell 2000. It's just your Dow that looks the more bearish there. If I were to take a look at the Ichimoku cloud, again, we're back close to an intermediate trend strength in the S&P. We're still in the cloud. We're back below the green line. Your diamonds is worse. We are, again, very close to intermediate trend strength. We are below the cloud and easily below the green line. Negative rate of change there, so you can just see how bearish that is. Looking at the Bollinger Bands, we are still out of the lower quartile, the lowest quartile. The nice thing here about this bearishness is usually this is what's really bearish, is when you have a contracting bandwidth that we break out of to the upside with a bearish move. The difference here is we broke out of this contraction with a bullish move. So it's opened up a big wide range. So it's going to be really hard for a bearish move to break out above the 150-day high on the bandwidth. So that's a positive development. So that's why I'm not too concerned yet about today's selling and long-term ramifications of it. I think it's just a down day for us here before we turn things back around to the upside. Obviously, you have a lower low. Obviously, you close in that gap, so that's not a runaway gap. Remember, we didn't gap down very much on the S&P. It was the Russell 2000 that gap down and looks more like a runaway gap there. But the S&P 500 did not. We did not form a runaway gap. We are back into the lower half of the chart. We are back below the value area. Still in the middle of last week's range. So again, put some context into how really bearish we are. We're not that as bearish as we think. Obviously, we did not get a new high or a new low. So that low point is, still, it's well below 70. We've already hit 0. So we are set up for a bullish breakout move at some point in time. It's just obviously not today. As we see, we're back into bearish territory here and back below the moving average. If we get back, to strong low point here, now we have to kind of concern ourselves with more of an extended intermediate decline. But as of right now, I don't expect that. Today, and part of the reason why is, this was a red flag. that we talked about yesterday, that we kept getting these small ranges, small volumes below the moving average. When you're below the moving average, you tend to get bigger than average ranges and volumes, like we did today, right? Today was a bigger than average range, bigger than average volume. So we saw that here, and you can see that's brought the relative ATR up to now its highest level, 1.2. Remember, you get up to 1.5 or higher on typical intermediate declines, so we might still have that as a possibility. Volume's not very strong though, a lot less volume now than what we even saw during that intermediate move when things really picked up to the upside. So again, nothing too concerning. One day does not, there were some red flags that suggested we might not be as bullish. And today kind of followed through on that technical environment that we went into today with. But again, even today doesn't necessarily say, oh, now we just can't be bullish, right? I think it's more just a one-day little drop. Again, we get these kind of moves when you're below moving averages, but we also tend to reverse these kind of moves with pretty strong bullish moves. And so we can see if that ends up being the case here, which I expect that we will. Your VIX jumped up, obviously, but not very much. Still below 16. You're barely above the 95% mark. Your VVIX is still almost is really close to extreme lows. So again, it kind of goes to show that even the VIX didn't really show a whole lot of concern with today's move. You're back above the 200-day moving average after getting below it yesterday. You're back above the 30 and the 50 as well, and we'll see if we get back above these. But I don't expect that we will get back above these short-term averages here. All right, now let's take a look at what's driving this price action. So let's go over to this asset class comparison chart. You can see gold's been on the decline, but from very, very strong 3-month returns to the upside. Let's take a look at just today alone. So take a look at the 5-minute chart. You can see the dollar was up strongly today. Big move to the upside. Yields were up pretty strongly too. TLT down almost 1%. What interesting, that's two heads of the three-headed monster. The third head is commodity prices, and they really struggled, which is interesting because usually that has been bullish lately. Obviously, was not bullish here today. International stocks struggling with the strength in the dollar, but but still outpacing all the U.S. Counterparts here, and real estate acting like QQQ is essentially is like a tech stock right now, or has been for last couple of years. So big drop at the very end of the day on the Qs, pretty much to catch down to where IWM was, so almost a 2% loss. SPY also had a big drop at the end here, and you can see high yield still outpacing Treasury bonds. So you wouldn't expect that to be the case. On a risk-off move. Let's take a look at some of the moves in these different asset classes, starting with the dollar. Remember that had a big run up to the upside, big bounce up, clearing some highs from the last few days. MACD is turned up slightly, stochastic still below the moving averages, but turning up as we're trying to get up above that 17-day or back above the 8-day moving average and moving up. So you can see the renewed strength. Let's look at the market forecast for the dollar as well. Renewed strength here in that dark green shading in the green line, intermediate line still in the upper reversal zone. So that's a pretty that's a strong strength in the dollar is what's kind of undermining risk appetite, and you can kind of see the impact it's had here today. If we take a look at yield, let's see if it's got it updated for today. It does have it updated for today and all the way through today. Good. So you're back above this 23% retracement level of this big retracement we've been on since the end of last year. Above the 23% retracement line, intermediate line still at strong bullish levels. Market sentiment is moving higher as well. Short-term sentiment has bounced back up from these kind of oversold levels, kind of an intermediate confirmation signal on yesterday's decline in the yields. So back up again here today. So strong move there. And then finally commodities is that third-headed monster getting a bull tag today. So commodities is set up. The intermediate line is crossing below market sentiment. So it's set up for a bounce here. We'll see if we end up getting that or not, especially coming off the lows. It's not as bad. Looking at crude oil, you can see we already have had bull tags, and now we're actually got dark pink shading and a red line and intermediate lines in bearish territory. So you've had a little bit of a pullback here in crude oil, which should start to impact these inflation expectation numbers a lot better. But keep in mind, though, that we're not quite out of the seasonality period for bullish crude. Crude oil tends to continue to rise up towards the end of June and retesting those highs at the end of July on average. So we're not out of the woods yet for higher crude oil, and we'll see. Again, with that bull tag on commodities, if we start to bounce back up on that, with the strong bullish trends going on the dollar and the dollar. Let's see here. Where's the Ichimoku cloud? The dollar and 10-year yield. So here's the dollar's trend. You can see strong, almost a mature trend strength there on the dollar, and then for the 10-year yield, you can see again also almost a mature trend strength. So very, very strong trends in both of those. They have very strong DMI patterns as well, without being too parabolic. You are above 25 on the dollar, so that's not parabolic there on the ADX yet. And then the TNX is above 30, but strong, but not parabolic either. We had got up to strong levels, but we've had a nice little pullback, so we'll kind of see how those continue. You saw the breadth today wasn't very good, especially by the end of the day today. We were down to back to negative levels in the McClellan oscillator. We haven't crossed below zero yet. That's significant when we do cross below zero, so we do need to kind of keep an eye on that, especially coming off of such a strong level to the upside. Here's what the weekly version looks like. Let me zoom out so we can see that a little bit better. There's the weekly version. We're not below the minus 500 level yet, which is, typically happens during correction modes, correction periods. So obviously we're not in correction, but again, very strong down day is going to have a negative impact on breadth. If you take a look here, let's take a look at the breadth indicators here. The number of stocks above the 50-day moving average dropped pretty sharply back to 200. So we're so close to getting above the moving average. We dropped down. We're back to a negative 5-day return on that. The number of stocks above their 200-day moving average did get above the moving average, its moving average, but then dropped back down pretty sharply as well. So you can see how breadth really taking a nosedive. New highs and new lows. Got up close to getting above 100. Dropped back down to negative levels. And I don't think this has been updated yet. No, it hasn't been updated yet. Yesterday, this was up to pretty decent levels. It's most likely going to drop back down, which is going to make it pretty much impossible. By tomorrow would be day number 10 for it to have to get to 61.5 by tomorrow, which is right up here. So it's going to be very unlikely that we'll do that with today's drop. So we're not going to get this wide breadth thrust. We can still get a breadth thrust here because we did drop below minus 100, but we have to get up above positive 100. And again, that's not looking very likely either. You can see the ratio chart of the Qs. Here, let's look at the Qs relative to IWM. So bear with me 1 second while I bring that back up. Qs relative to IWM. So you can see we started off strong. It still finished the day up, so it's not red, but you can see all the moving averages here, and the problem is as we go sideways, since we really started this sideways action back over here in the middle of January, the 200-day average for this ratio has really gone up quite a bit. And as I've shown you before, the rotation continues to move into safety, right? Healthcare, staples, utilities, real estate, even moving up on it. Again, it was down today, but on a relative basis is moving up here. Even discretionary is doing okay, but technology and communication services, which has some of the bigger names, and just not doing well at all. And when you look at how technology is doing here, let's take a look at technology relative to, here, let's pull up this chart. Technology relative to its peers, back below its 17-day moving average, still below the ratio, still below its 50-day moving average. So you're still very bearish on this chart, VEXLK relative to the S&P. Here it is. When you look at it on this basis, Again, it's typically pretty positively correlated with the markets. It's below its 200-day moving average for the first time since 2022 when we had that correction. Right, so if I were to zoom out so you can see that. So there's the drop below the 200-day moving average in the past week or so. That long-term PPO was falling close to getting to zero, which would be kind of like a death cross of the 50 below the 200-day, which there they are right there. The 30-day is crossed below the 200 now, and you can see kind of the strong bearishness that we're in. That's on the daily chart. If I were to switch this to a weekly chart, again, we are below the 50-week moving average, so it's kind of like the 200-day there. There's the 200-week that we did test on the correction. You can see the MACD is negative. The PPO has just turned negative. The long-term PPO has turned negative. So we are just kind of turning bearish on technology relative to S&P. If I were to look at the other side of the equation and look at utilities relative to the S&P, which did pretty well during the correction, is back above its 30-week moving average here. MACD is bullish for the first time in more than a year. And you can see the long-term PPO is starting to turn up as well. Even the weekly CCI has gotten up to 100. So that's on the weekly chart. Here's the daily version of this chart. Here, let's go to the daily version. Go back to the 1-year chart. And you can see on the 1-year chart, we are close to crossing above the 200-day moving average on XLU relative to the market. So, big opportunity for for things to turn kind of bullish here. Let me zoom out again so we can see that long-term PPO, which has been so negative here. See, it's turning up and moving up towards zero with pretty much the strongest MACD that we've seen in a while, right? Since that last hurrah in 2023 when the markets really turned bullish and this moved its way to the downside. And you can see there's not, where the correlation is not, it's right at zero. So, there's an opportunity for this to turn back down, and for this to turn back above the 200-day moving average would be a bearish pattern. So these are kind of some important ratios that they kind of keep an eye on. Let's look at XLY relative to XLP, another kind of risk appetite. Having broken below its 200-day, today breaking back below the 8 and 17-day moving averages after a nice little rebound it's had. You can see its long-term PPO falling down. The ratio is turning back up to regular positive levels. If I were to look at the weekly version of this, again, we are below the 50-day. We already are below the 50-week. We already are below the 200-week moving average. The 8 and 17 have crossed below both the 50 and at least the 200-week. The MACD is bearish. The long-term PPO is turning lower to the downside. Some bearish indicators and all these other RSI and CCI, positive correlation with the markets. So you can see how that's kind of a red flag too in terms of potential risk appetite going forward in the long term, as long as we sit below not only the 50 but also the 200-week moving average here. And that brings us to our how the different sectors did today. So we'll look at the sector rotation chart. Energy, which typically does pretty well during a risk off move. Not so much today. It was down 3% today, but there's XLK and XLY down big. XLC barely underperforming the markets there. Other cyclical areas, economic growth sensitive areas like industrials and materials down quite a bit. Real estate kind of matching. Remember, it acts kind of like a tech stock right now. And then you have your safety trades up here at the top, and they were rotating into those favorites just because they're not going down, they're not going up, doesn't mean that we're not rotating into them on a relative basis, and that continues to be the case. We are really moving. That's on the daily version. Here's the weekly version of this, and how we're moving from one week to the next. Materials and energy doing well, but there's utilities and staples really moving far to the right, up in the improving category. XLY is right there, XLK is right there, and XLC is in the weakening. So even on the long-term basis, we're moving towards safety trades rather than the cyclical areas of the market. All right, now let's take a look at our trade idea of the day. It's actually on Wynn Resorts. It also dropped pretty sharply here. Actually dropped a lot more and after we put the trade on the Market Outlook live video. that we do at 3:30 Eastern time. We finished nearly 9% below the moving average. The intermediate line still in the reversal zone, so well below falling market sentiment, which has dropped into the lower half of the chart. Short-term sentiment's bearish there. You can see the weekly candle has dropped down, closing below the 40-week moving average. We are that close, 1% away from a death cross showing up on the chart. When you look at obviously you have 3 red arrows with some pretty decent volume today. You broke below the 200-day moving average, which is the significant deal that kind of stood out to me. MACD and stochastics are down big. If you look at some of the other oscillators like the DMI, you're going to see a bearish pattern here as well. Here we go. A bearish pattern here on WIN. Well above 30, and you're just barely getting below 20 on the positive indicator. Looking at the RSI and the CCI, they're also showing bearish levels well below 40 there, below 150 on the daily. We're just breaking below 100 on, we got to 97 last week. Well, we're breaking below 100 this week on the weekly CCI. Looking at the Ichimoku cloud, you can see a strong bearish trend. Intermediate trend strength, well below the cloud, strong bearish rate of change. Looking at the Bollinger Bands and the Keltner channels, we are not out below the lower band because the bandwidth's pretty strong here. But we are in the lowest quartile, and we are way below the lower Keltner channel. So with increasing bearish momentum, it's pretty darn strong there. So bearish move, to say the least, on WIN Resort. So what we decided to do here was come down and sell the 85, which was at the time at a lower 20s on the delta, buy the 87.5. That gives me this trade right here. So the stock is down just a little bit since we got into it at the very end of the day today. It's got about a 2.5 to 1 reward to risk ratio, and this is how much room we have to work with from a timing standpoint before my maximum gains outside of a 1 standard deviation window. So I like that setup there, and we'll see if it continues lower. It's got to get down below 85 for us to get to, so that's going to be down in this area here. So it's got to kind of retest those lows, which if you look at this chart here, again, 1 standard deviation going into June is down to 80. So we just have to get below 85, which is 1 standard deviation for May right now, and we can be able to get to our maximum, close to our maximum gain. By May, it would be close to our maximum gain. We'd have to wait for June to get the time decay to get actually all the way to maximum gain there. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us at marketscholars.com for free. Follow me and like us on Twitter and Facebook as well. Have a great rest of your Tuesday night, everybody, and we'll see you all next time.